Depending on a person's needs, desires, and health condition, there are many types of insurance available. This video will help you understand and determine what protection you need today while keeping in mind what may be important tomorrow. The first type of insurance is called life insurance. The loss of an income earner, especially early in life, can cause extreme financial hardship for those left behind. How will the mortgage be paid? How will the children's education be funded? Will the family have enough income to maintain their standard of living? Life insurance can help your loved ones deal with the financial impact of your death. Life insurance, what is it for? The death benefit paid from the life insurance policy is a tax-free lump sum amount that can be used to replace your income so your family can maintain their standard of living to provide for your children or dependents, pay for funeral expenses, pay off your debts, make a gift to charity, or you may also choose to leave the money to your estate or to a trust. There are two types of life insurance, term and permanent. Term life insurance pays a death benefit if the person insured dies within a specific period of time or before you reach a certain age. With term insurance policies, your premiums only pay for the cost of the insurance. There is no savings component or cash value. As a result, the initial premiums on a term insurance policy are generally lower than the premiums on a comparable permanent insurance policy. If you stop paying premiums, the coverage expires. Term life insurance can be renewed once the coverage is nearing expiration, but costs will be based on the insured's age at the time of renewal. On the other hand, permanent life insurance gives you coverage throughout your lifetime, which means coverage will never expire. Your survivors will get payment if you die at any time while your insurance policy is in effect. Permanent life insurance policies can build up cash value. This means you'd get a cash value back if you cancel your policy. You may be able to take out a policy loan or use your life insurance policy as collateral for a loan. There are two types of term insurance, as well as two types of permanent insurance. For term insurance, first is the joint first to die. A joint first to die insures two people under one joint policy, pays the death benefit when the other partner dies, gives each partner the same coverage, and is usually less expensive than two identical single policies. It is sometimes less flexible than single policies if the couple separates or gets divorced. Usually pays only one death benefit, so if one partner dies, the other needs to apply for a new policy to continue coverage. A single term insurance provides each partner with their own policy, gives each partner their own coverage amount, is usually more expensive in total than a joint first to die policy. A single term insurance also makes it relatively easy to change the beneficiary if you separate or divorce. If you decide to purchase insurance, make sure you consider all the options available to you based on your needs and your goals for the future. Make sure to consider the pros and cons of each. On the other hand, for permanent insurance, there's the whole life and universal life. Whole life insurance is a type of permanent life insurance that provides you coverage for your lifetime. Your premiums won't change as you get older. Your policy will often have a guaranteed minimum cash value, while universal life insurance is a type of permanent life insurance that combines life insurance with an investment account. The investment account has cash value. Withdrawals as well as loans may be permitted. The death benefit and cash value of your investment account may increase or decrease depending on the types of investment you choose to hold in your account or the returns on those investments. The second type of insurance is disability insurance. Disability insurance can help protect you and your family from an unexpected illness or accident that leaves you unable to work and earn an income. Your ability to earn an income is quite simply your biggest asset. During a disability, household bills still need to be paid. Disability insurance provides a benefit, usually 60 to 85% of the annual salary, in the event the insured becomes disabled and is unable to work. There are various types of disability coverage, ranging from policies that will only pay benefits if you are unable to work at any job, to policies that will pay benefits provided you are unable to perform the duties required for your regular job. Many employers offer their employees group benefit disability insurance coverage. However, self-employed individuals or individuals who are not covered through their employer should ensure that they have adequate insurance to cover their own cost of living while they're unable to earn an income. If you're considering disability insurance, make sure you check with your employer to see if you already have group disability coverage with their employer's plan. Shop around, especially if you're considering private disability insurance. Consider group insurance offered through a union, guild, or professional or alumni association. Premiums for this type of coverage usually increase as you get older. You'll need to renew your insurance every few years. There are two types of disability insurance. First is the short-term disability insurance. Short-term disability coverage typically provides benefits for up to 6 months while you're sick or injured. If you don't have short-term disability coverage and your employer does not offer one, you may be eligible for EI or employment insurance sickness benefits. On the other hand, long-term disability insurance benefits generally begin when your short-term disability insurance ends, or when sick leave benefits from your employer ends, or when EI benefits end. Most long-term disability plans will replace 60 to 70% of your normal income. Each disability plan is different. Some may provide disability benefits for up to 2 years if you're unable to return to the job you had before becoming disabled. After 2 years, you may continue to receive benefits only if you're unable to work at any job. The third type of insurance is critical illness insurance. Whereas disability insurance usually pays a monthly benefit equal to a percentage of your salary in the event you are unable to work, critical illness insurance pays a lump sum tax-free benefit shortly after diagnosis, regardless of the ability to work. This can help pay for items related to the illness, such as medical expenses that are not covered by a health plan, mortgage payment, private home care, or a much-needed vacation. These plans come with options to cover you for a certain number of years or based on the age you would like to be insured. Critical illness may include cancer, Alzheimer's disease, heart attack, or a stroke. The amount you receive as a benefit will depend on the amount of coverage that you choose. The insurance company usually pays you the benefit after the diagnosis of condition covered by your policy. Insurance companies can differ in how they define critical illness, what conditions they cover. Check with your licensed insurance agent to learn about which conditions your policy covers. Read the policy carefully before signing. Make sure you understand what your policy does and does not cover. And last but not the least for this video presentation, let's talk about long-term care insurance. As the population ages, more and more people will experience the need for long-term care. The expenses associated with these services are likely the biggest risk to retirement savings and should be an integral part of every retirement plan. Canadians want the peace of mind of knowing that they will be able to afford the care that they need without burdening their families with the costs. Long-term care insurance provides a benefit that helps cover the cost of nursing home fees or attendant home care fees. Most plans generally pay a stated daily or weekly benefit once it is determined that the insured is no longer able to adequately care for himself or herself. Other plans offer a pool of money that allows a percentage to draw periodically. Risk management is an important part of financial and estate planning. Life insurance, disability insurance, critical illness insurance, and long-term care insurance are just 4 of the basic solutions to managing risks. From the payment of the first premium, protection of one's income and estate can be established. It is important to consult with a licensed insurance professional to determine the most appropriate solution for your insurance needs. If this video presentation was helpful to you, please share the link to your friends and family who may also need this kind of information. And if you want to know more or curious about eligibility and pricing, please do not hesitate to contact your trusted financial advisor or visit prosecurefinancial.com to book a free consultation. Thank you for watching. Please subscribe to our channel for more videos related to money management and finance.